Hello and welcome to ESG Talk, your go-to source for insights and advice from leaders in environmental, social, and governance. I'm your host, Steve Soter. I'm joined today by a familiar voice, my co-host and colleague, Andie Wood, as well as a special guest, Alyssa Zucker. Alyssa is a new member of the team here at Workiva and the former Chief Sustainability Officer of Sustain Life, a startup recently acquired by Workiva that became the foundation of our newest solution, Workiva Carbon. Alyssa is also the host of the Week in Sustainability podcast, a show that gives you analysis and commentary from our team of experts about the week's most pressing news and issues in sustainability and ESG. Alyssa's show is a perfect complement to ESG Talk, which brings you candid interviews with some of the biggest movers and shakers in ESG. Today, ESG Talk and the Week in Sustainability kick off a four-part crossover series leading up to Climate Week in New York City. And for those of you who aren't familiar with Climate Week, it is a huge annual event to promote climate action that began in 2009. In that spirit, we'll be focusing on greenhouse gas emissions and carbon in particular, its management, measurement, and reporting, and the unique challenges associated with Scope 1, Scope 2, and Scope 3. Andie and Alyssa, thank you so much for joining us today.
Thank you, Steve.
Yeah, thanks for having us.
Alyssa, let's start with you. I'm wondering, to get this conversation started, could you maybe provide a brief overview of greenhouse gas emissions for all of our listeners' benefits and maybe explain as a part of that the core principles of the greenhouse gas protocol?
Absolutely, Steve. So, foundationally, what greenhouse gas accounting is the translation of business activities into an emissions output. And the accounting exercise involves a couple of different factors that translate something like electricity consumption or fuel consumption or miles driven in a car into that final output of emissions. And the other really important piece of greenhouse gas accounting is we always kind of like to shorthand this as carbon or carbon accounting, but it's not just carbon, right? There's other gases involved in this. There's actually 7 of them that were originally identified in the Kyoto Protocol, back in 1997. And so what carbon accounting is doing is actually translating all of those different gases into a single unit of measure so that we can compare the climate change and emissions impact of different activities on a single playing field. And that unit of measure is a carbon dioxide equivalent, or CO2e. Then just to talk a little bit also about you mentioned the principles of carbon accounting. And there is actually a standard and a guide, the gold standard, the greenhouse gas protocol. And it actually is principle based. And there's 5 of them that really dictates how it is a company wants to go about putting together their greenhouse gas inventory. And those 5 principles are relevance, completeness, consistency, transparency, and accuracy. And so the greenhouse gas protocol kind of walks companies through how you go about thinking about compiling an inventory, setting your boundaries, identifying the activity, and then again, quite anchored on data, how you actually go about translating the data you do have into that emissions output.
Well, I've already learned something, which is that it's more than just carbon dioxide. A little embarrassed to say that, and actually to get into that point, of course, carbon dioxide gets the most attention, but as you mentioned, there are other greenhouse gases. Andie, considering this wide range that Alyssa went through, then how critical is it for organizations to track and report emissions beyond just carbon?
Yeah, there's always one that gets all the attention in any group. And if you were thinking of this as some kind of ensemble band, maybe, then carbon dioxide is the star that sits right at the front and probably does all the lead singing. But one of the answers that I use a lot, especially in something like this accounting space where there is judgment and there is that subjectivity that Alyssa just talked about, is that the criticality of what decisions you make depends on your organization, and it depends on your assessment of your materiality, and it depends on your assessment of your impact. So some of these other gases like methane and nitrous oxide, I mean, methane has carbon in it, so there's a reasonably direct link to what's going on there, but it's also a very powerful gas in terms of greenhouse effect. But then we get nitrous oxide and some of the fluorine-based gases, and we're starting to get into the territory of gases that, for example, are used in refrigeration. So if you're a company that has a lot of refrigeration in its systems and at some point will be releasing those gases into the environment, then obviously tracking those emissions is probably going to be quite important for your business. That's going to be one of the major impacts that you have. So I think it comes back to one of the topics that I don't think it is possible to ever not mention on an ESG Talk podcast, which is that materiality is really important. But there is some really interesting, it is worth remembering that those gases exist, because obviously it is very hard to go and look for an impact if you are not aware that there might be an impact in the first place. So do go and have a look at things like the protocol and the gases that it lists. Do maybe get some advice, have someone come and talk to you and say, hey, it is worth, do you have any of these others? Or we know what kind of industrial processes you've got. You might want to keep an eye on some of these other emissions, but maybe for other reasons that aren't actually about greenhouse gas tracking, for example.
Well, and it's a good reminder that those musicians at the back of the stage, they're part of the band too. But let's maybe focus again on that lead singer, as it were. And Andie, I'll direct this back to you. Why is carbon accounting crucial then? I mean, you kind of highlighted some elements, certainly materiality is an aspect as well, but maybe take us to the heart of why this exercise is so important.
Materiality, one of the things that was often said when the European sustainability reporting standards were being put together, there was this idea that the climate standard would be mandatory. And then there was this idea that, well, we need to apply materiality to this, otherwise it's all going to be a bit silly. But I think one of the expectations out of that was it's very difficult for a majority of companies to not see reacting to climate change as material for their business. And the reason for that, of course, is that we are doing carbon accounting because we are trying to track the impact of that carbon dioxide on our changing climate. And the problem with a changing climate is it's a pretty global thing. It is quite hard to operate or exist somewhere on the planet without one of the downstream effects of climate change being something that potentially impacts the businesses and their revenue streams. And of course, that impact on revenue, that impact on corporate value is one of those things that really goes to the heart of what a lot of companies are trying to do. So I think carbon accounting is something that enables a company to have a proper idea and a full understanding of exactly what it is that they are producing, what carbon they are responsible for, wherever it is, and also allows them to therefore understand what their role is in that environment and whether they need to make any changes in order to mitigate those impacts, understand the risks, understand the impacts, but also, as we always forget, but we need to mention on the other side of the house, understand the opportunities. Where there is something in climate and those impacts, where addressing that is producing opportunities for business to change their business plan in a way that makes money.
And continuing on that theme, then, Alyssa, given the importance that Andie just laid out of accurate carbon accounting, I'm wondering, and you got into this a little bit earlier, but maybe could you go back and outline some of the fundamental principles and methodologies that are used in calculating and reporting carbon emissions with kind of the background and the rationale behind it in mind, as Andie just described?
Yeah, absolutely. And one thing I actually did want to add to our band on the stage metaphor here is that those backup singers, those other musicians, actually now also have to be included in your disclosures. They really are just as important as the lead singer. All of these different reporting frameworks are compelling companies to say, not just what is your CO2e total high level number, but all those constituent gases. How much methane are you emitting? How many, nitrous oxides are you emitting? But let's back it up a little bit and go into kind of the foundational building blocks of carbon accounting. And there's scopes 1, 2, and 3. Scope 1 are direct emissions from sources that your company owns or controls. And the shorthand that I always like to use to describe this is burn. By far and large, Scope 1 emissions are generally when your company owns or controls the asset and is physically burning the fossil fuel and sending the emissions into the atmosphere. They're directly controlling that. Scope 2 emissions are also energy related, but these are indirect emissions. And so think of this as electricity consumption is generally the easiest one to attach to here. Your company consumes electricity, but it's not generating it, right? The consumption of that electricity isn't actually what's sending those greenhouse gas emissions into the atmosphere. It's the power plant that's burning the coal or the natural gas or utilizing the solar panels. So their Scope 1 emissions are actually your Scope 2 emissions from the production and then subsequent consumption of that electricity. And that's actually a really important part that I always like to point out in carbon accounting, because double counting is okay. This isn't about getting to one collective global single number of emissions in the atmosphere. This is about accountability. This is about transparency in terms of what you're doing as a corporate actor and what its impact is. So then we have also our Scope 3 emissions. And I always think of these with our 3 Bs as beyond. So this is everything that supports your business but is outside of its control. So this is your employee business travel. This is your employee commuting. These are the goods and services that you produce and that you purchase to support your business. And scope 3 is really nebulous. It is challenging because the data for that exists outside of your organizational boundaries, right? And so the way that the greenhouse gas protocol actually guides companies in how to get this information, whether it's the energy related information or whether it's from your broader value chain, they provide a methodological hierarchy that anchors on the quality of data available. And it takes companies on a journey of always balancing comprehensiveness and completeness. That's the seesaw that you're always on as you're putting together your carbon inventory. Because in a perfect world, we would all have the best quality primary data. We would know the carbon impact of every single thing we're doing and consuming and engaging with and creating. But that's not how it works in reality. And so oftentimes we're using representative data or what we call proxy data. And that is used, as a mechanism to kind of fill in some of those gaps. And so the actual hierarchy that exists is first and foremost, the best quality data, supplier reported data. So in our electricity consumption example, this is you're purchasing electricity and your provider is telling you the exact carbon dioxide equivalent content in the kilowatt hours that you are consuming of that actual electricity. It is directly reported from your supplier. It's really precise. But again, your supplier has to have that data to furnish it to you. So next down in our kind of hierarchy is physical. So that's again with electricity, you're buying it from the utility and there's kind of publicly reported data sets where you can look it up and say, all right, I'm not sure if it's this exact supplier, but in this general region, here's the emissions intensity of a kilowatt hour of electricity that's consumed. That's still really good primary data. And then when we look at the proxy side, there's generally two ways that you can get proxy data. One is what we call average data method. And this basically is reflecting industry average, that estimated representation for how much energy you're consuming and can follow on with the same kind of emissions calculation. And then the very last one I'll mention as proxy, it's a similar idea, but is a spend-based calculation. And so this is actually often where companies start because it's the data they have access to. Most companies are pretty good about monitoring where they're spending their money and what they're spending it on. And so you can similarly utilize different statistical models that translate dollars spent on certain goods, commodities, services into a very representative emissions output. And so again, the kind of journey that companies are often taking is many times they start there and they just say, we're trying to wrap our arms around this, especially on that scope 3 side.
Well, the accountant in me has this entire conversation been trying to relate, carbon accounting with financial accounting. I will tell you, financial accounting is definitely more science than art. Double counting is not okay unless you're talking about a debit and a credit. But much like accounting, regardless of how you're getting this data, and I actually love the description that you gave of, well, if you don't have this, you can't actually use that. Regardless of where it's coming from, you've got to have a place to put it, right? And so now one of the questions I'm asking myself is, how are companies currently tracking this? What systems and strategies are they implementing in order for people to come in and review, and particularly people to come in and audit? We haven't really talked about the assurance aspect, but as we know, and I'm assuming most of our listeners know, that a lot of that data will shortly, if not already, be subject to audit assurance. Can you tell us what's going on there? And Andie, maybe let's start with you, but Alyssa would obviously want you to weigh in on that question too.
Well, I think obviously we've heard Alyssa talk in some good detail there about some of the uncertainties that exist within the data collection. And obviously that's a thing to address. But once we get into the world of assurance and audit, we start to need to not only know what those uncertainties are when we collect the data, but we also need to keep track of it. And then we also need to keep track of how we collected the data, who we collected it from, and what we've done with it on its journey from being, hey, I'm now a piece of carbon information that has entered your system, to being, collated up and pulled all the way up to the top and being put into those final disclosures where they go into the categories and we report on our scopes and we say which gases and which operations are doing what. And that's a massive journey for a piece of data. I think how companies are doing it at the moment and how they should be doing it to prepare for these audits is probably a slightly different question. And I would love to talk about maybe how companies should be doing it a little more, because that's where we get into this realm that, as an accountant, Steve is extremely used to, But a lot of other areas of business, it's not something that they've had to operate in necessarily. But it's not always natural to everyone, which is understand and track and keep an eye on the versions and monitor the changes and know who made it and document everything. Always document everything.
You hit on so many of the key words with document everything. I mean, that's the overarching message here. Now that emissions have to go through an assurance-based audit process, we're really seeing this transformation, or maybe like the meeting of carbon accounting and financial accounting. We're really applying these principles of financial accounting onto carbon accounting. And like Steve mentioned, there is a challenge there because they're similar, but they're also different, right? The subjectivity, the optionality that's involved in carbon accounting does not exist with its financial counterpart. And so, in preparing for audit, the things that companies are now expected to do is really show that audit trail of where did this data come from? What manipulations were done to it? Who made those manipulations? What assumptions are made here? Where are there estimates or gap fillers? Is there any missing data? How were those estimates derived? What was the transformation process? Which methodology did you use to transform that activity data into a carbon output? And there's a lot of details in also doing it. We barely scratched the surface. And I think what we're seeing most importantly now, and what actually so much of this disclosure is really driving, is the transparency in those methodologies. And it's really acting as an anchor point to say, okay, companies have been doing this a little bit different, right, in the past. And what the audit is requiring is be transparent with your methodology. Because at the end of the day, when you're going to go through assurance, starting with limited and going to reasonable, that's the exercise, right, of the auditor saying, okay, I don't think there's any errors here. This looks good enough, right? Versus, oh no, this is actually all factually right and can be, proven so with very limited risk. And so that's kind of the exercise that I think companies are going through right now in terms of really going through with a fine-tooth comb all of their data, their processes. It's the data lineage. It's those internal controls on the data governance of where is it coming from, what's happening to it, and how are we reporting it at the end in terms of what it really represents.
You two think financial accounting doesn't involve a million decisions. You clearly are not IFRS accountants.
Well, I mean, it is true. It is absolutely true. And in some aspects of accounting, I mean, there are going to be subjective decisions, but it actually gets back to that documentation aspect as well, is that, hey, when you are subject to judgmental calls, subjectivity, your auditors or your regulator for that matter, they're going to want to know, what did you know? When did you know it? Why did you make the decision that you made? And that is, I would say, contemporaneous documentation, which I talk all about that when it comes to like cybersecurity incidents. We're not going to go there, but that is so important when somebody inevitably comes asking you, okay, you made this conclusion or you have this disclosure. Take me all the way back to the beginning. Alyssa, the other thing I was going to say, I feel like as a former controller, that like that sort of list that you laid out at the very beginning, that's like my love language. Actually, I was actually once asked, like, hey, as a controller, like, what do you need for confidence? And I actually came up with a list. There's a blog on it on Workiva's website, but it was a lot of the same things. Where did the data come from? Was it the right system? Did it flow correctly? What process was used to aggregate or transform it? Were the right people involved? Was there evidence? Do you have an audit trail? Can you tie it out? I mean, I just find it so fascinating that we actually get back to those really core, financial accounting principles, in order for people to get confident on the carbon accounting and disclosure side.
Well, we are trying to raise it to the level of financial reporting very explicitly if we're talking about European regulation. But I think the other place that we start to think about audit trail is we focus on the fact that an audit trail is for the assurance procedure and the auditor. But a lot of the disclosure is narrative disclosure, talking about how a company is making these judgments, what decisions it has made as well. So as well as this being information that it is valuable to have available for your auditor to go through, bear in mind that you're also going to be drafting disclosures because your investors will want to know this, or your other stakeholders will want to know this information as well. And I've had quite a few conversations, and investors, for example, are not just going to be focusing on the metrics. I have also heard them say, we want to see what is in those governance disclosures. We want to see what is in those decisions. That is also important information to us. So it's information that's well worth having for all the way through the process, including the transparency piece.
Well, we've certainly covered a lot about carbon accounting and, I'd say maybe more than just the basics, but maybe let's transition and talk a little bit about some of the practical applications. Andie, let's go back to you. I'm wondering if you can share some examples of maybe effective carbon management processes and again, how all this really like happens in practice and what organizations are really doing with all this.
An effective carbon management practice depends on what it is you are trying to manage. So it comes back to really understanding where the impacts are coming from. So I think a really good example of this is organizations with products. There's a lot of effort that for some of those organizations to go through where they don't just say, well, hey, I'll use those estimates and I'll use those assumptions to have an overall understanding of what the carbon impact of my product is. They might go through and do a more detailed assessment of where in that product life cycle actually has the highest impact. Where is the most emission of gases happening? Where is it possible to have the most impact by changing something in the process or by changing materials? So there's a certain level of impact that comes from making changes to processes, identifying and changing in processes. Efficiency can actually be a surprisingly impactful thing to do with a process. So we're not necessarily talking about the big dramatic headlines of picking up sustainable aviation fuel or switching the entire power generation. Sometimes it can make quite a big difference to just go through your entire process and make it 20% more energy efficient. That's a pretty big cut there before you've done anything else. And then we can also start to look at, well, there's a lot of speculation at the moment. There's a lot of research that's going into carbon management from the perspective of using technology to try and actually take carbon back out of the atmosphere. There's carbon management in the sense of looking at industrial processes and sort of trying to trap emissions before they actually go anywhere. So not changing the process, but being able to process and trap emissions and deal with them in a different way or find something that stores carbon for a long time. And that's one of the reasons that all this accounting actually is very important. And that's how it starts to have these practical impacts. Once you dig into where the gases and the emissions are coming from, that's when you really start to understand where your impacts are. And sometimes it is something really surprising.
And is it fair, just a quick follow-up, Andie, is it fair to say that when you're evaluating those options of I'm going to make a dramatic change versus I'm just going to get more efficient, is it fair to say that you look at that through two lenses? You look at that both through the impact lens, but also just the pure cost dollar lens? Well, hey, if I'm 20% more efficient, that probably means I had some savings elsewhere. I'm just wondering, how are organizations prioritizing that, or at least from what you've observed?
Well, I think when we are in the business world, it is inevitable that that currency value is something that a business has to pay attention to. And that efficiency argument, actually, that one really does come back to thinking about this in terms of not just the impacts and the risks, but getting to the end of that three-letter acronym and getting to the opportunities. Because obviously changes do need to be paid for. And then ideally, some of those efficiencies do start to go into the realm of actually making efficiencies can get you money back. It does all have to come back, to still being able to function as a business and still fulfill the other side of the house. But that's why integration is so important. It's because this is never just about some non-financial data. It's always about the combination of the impact on measuring the non-financial impacts and what it does to the financial information as well.
Yeah, I will actually double click on the efficiency point, which is that's where companies generally do, but also should start, right? That's the simple mathematical equation. You put in a little bit of CapEx, you're going to have operational savings, and you're going to have an actual financial ROI. There will be a return on your investment where in the long term, you are spending less money than you used to spend to operate. So always start with the efficiency measures. And Andie's right, they're not always the most exciting ones. Putting VFDs on fans, weather stripping buildings and spaces to improve building envelope performance, right? There's not necessarily news headlines about doing those things, but that's where you reasonably start to actually just consume less energy in the existing things that you do. And then I think when you look beyond that, you kind of get to the harder stuff, the value chain stuff, right? A couple of years ago, Procter & Gamble did a huge educational campaign to their users on using cold water in Tide washing cycles. And why did they do that, right? It's because when they put together their emissions inventory, what they realized was that the vast majority of emissions associated with the use of their product with detergent wasn't actually the detergent itself. It was the energy expended to heat hot water in washing cycles. And so what did they do? They worked with their scientists and R&D, and they said, let's design a product that is just as effective in cold water cycles, and let's educate all of our consumers that you don't need to use hot water. You don't need to consume all of that energy, right, in using our product. And that's some of the stuff that companies will ultimately look to as they kind of progress on their journey. From the upstream side, from working with your suppliers, this is where it's things like including requirements in RFPs and contract language, specifying we want you to use renewable energy. And there's kind of like the RFP contract and request, but then there's also kind of the enforcement side of it and how do you monitor it. And so this is like the data acquisition and the monitoring of saying, we want to understand what your impact is. This is what suppliers are experiencing today. Their large buyers are saying, hey, we're paying attention here because your business activities materially impact us and our emissions that we now need to disclose. So we're going to make sure that in our business relationship and ongoing process, we're encouraging you or requiring you to change these behaviors, and we're actively monitoring to make sure that you're doing it.
Well, we talk about headlines. I will tell you that when the Soter household transitioned to an electric snowblower, there were a lot of headlines. So much better here in snowy Salt Lake City. As we kind of start to wrap up here, and I'm sure as many of our listeners know, Climate Week is returning shortly with a clear message that it's time. And this episode, of course, couldn't be more timely as we dive into climate action and carbon reduction. Alyssa, let's go back to you. What are some of the different approaches for reducing greenhouse gas emissions? Of course, we talked a lot about it just now, but maybe not just reducing greenhouse gas emissions, but also transitioning to what's referred to as a low carbon economy generally.
Yeah, so I would say, frankly, in addition to the things I just mentioned about the efficiency, operationalizing decarbonization, choosing renewable energy sources, working throughout your supply chain, that's kind of the action and relationship management that companies are going to be taking moving forward. But in terms of high level, I would also just say start building your bench, right? In terms of how it is you're going to measure this data, how it is you're going to make these operational changes at your organization, the teams that you're going to engage, both internal and external stakeholders. I think across the board, we are seeing that the sustainability org, that silo is disappearing. Where we are today is sustainability really integrating into the core business strategy of how a company thinks about its long-term resilience, how it thinks about risk and opportunity, exactly what Andie was mentioning before. We're really at that transition point where this is a value add. This is an opportunity to kind of be taken advantage of, to see the opportunity in front of you. And so I would just say to companies out there, start with the basics. Understand what are my organizational boundaries? How am I going to actually align my carbon accounting with my financial accounting, right? And reporting so that these are apples to apples and really have an inclusive and comparable kind of total that we're getting to here. And then the last thing that I do really want to say is document your processes. You are going to be asked this question. How did you do this? Why did you make that judgment call? And the point of that is to force you to defend your decisions. They're not wrong. They might be. You might learn from them, right? But it is document everything, because you are going to be asked why and how and what at a very granular detail.
And I think to add on to that, which I love, is that not just in order to have a defensible position or at least a starting point, just from an efficiency and process standpoint, documentation is going to drive repetition. Repetition should improve efficiency, accuracy. I mean, all of those things. So it's not like it's a one and done benefit. Again, if you're doing it the right way, you should be able to be realizing those almost as dividends, right? Like time after time after time. Well, phenomenal discussion. Andie and Alyssa, thank you so much for joining us, for sharing your insights, for educating me. It has truly been a pleasure. I'm sure it has been for our listeners as well. Thank you to both of you again for joining us.
Thank you, Steve.
Yep, pleasure to be here. Thanks.
Thank you for joining us for this episode of ESG Talk, brought to you by Workiva, the world's only unified platform for financial reporting, ESG, audit, and risk. If you enjoyed this episode, tune in next week as Andie dives deep into Scope 1 with the Chief Sustainability Officer at Delta Airlines. They'll be discussing strategies for reducing carbon emissions, including Delta's internal sustainability working group and its collaboration with external partners to encourage the scale of sustainable aviation fuel. If you enjoyed this episode, tune in next week for a deep dive into Scope 1 emissions, which are the GHG emissions that occur from sources that are controlled or owned by an organization. In the meantime, as usual, please rate and review us on Apple Podcasts and subscribe for future episodes on Apple, Spotify, or YouTube. We'll talk again soon.